Good evening, everyone. Thanks for joining me here today for today's webinar. My name is Ethan, Education Lead here in the IG Singapore office. And today, this webinar will be talking about one of IG's product knockouts. And I will also be sharing a trend trading setup that we can potentially use when we spot some opportunities as well. So I'll be going with you through two things primarily. The first thing is on the product itself, and the second thing is on the trading strategy and also the rules and conditions for the entries and exits. Okay, but before I begin today's session, right, I just wanted to do a very quick check on the technical side of things. If you're able to hear me right now, can I trouble you to type in a yes in the question box? So you should be able to locate this question box inside the GoToWebinar control panel, be it you're joining us from your phone or on your PC. So if you can hear me, please type in a yes. Okay, thanks, Joel. Thanks, Mimo. I see a few yeses coming in. Okay. Thanks, everyone, for confirming that you can hear me. Thanks, Sean. So before that, right, I just wanted to highlight that because this webinar, right, I'm actually hosting it from the Singapore office. If you don't happen to see this product, if you are trading with other IG officers, please just reach out to your local officers or the IG branch that you are trading with and speak to them. All right. Okay, so moving on, I just want to do a very quick introduction about myself. Once again, my name is Ethan, and before joining IG, I was in another brokerage called Philip Nova. Back then, they were known as Philip Futures. I was doing more of like a BD role, business development, working with exchanges, and also more on the account manager side of things before transiting to IG. Okay, so lesser about me and more on today's content. So broadly, I'll be introducing you to one of IG's product knockouts and the features of this product and how we can again spot trading opportunities, and then we use this product to execute our views. Okay, before I start the session, I just wanted to highlight that trading is a high risk endeavor and you can potentially even lose more than what you have deposited in the account as well. And sometimes when there is this market dislocation or like a market gap, right, you may find yourselves experiencing some huge losses if you're on the wrong side of the trade. When that happens, right, you can actually wipe out your whole capital in your trading account. And in the worst case scenario, you may even go into an overloss situation. So overloss situation means that after you cleared all the money in your account, you can still be owing your broker money. So just be very careful on that. Okay, so just take a read on the risk disclosure as well, and take note that the session today, right, will be purely educational in purpose. And if I happen to provide any form of like a market view, right, please do not treat them as trading advice and do your own due diligence before you enter any trades. Okay, so when it comes to leverage trading, right, let's just look at trading itself from the macro perspective, right, from a bird's eye view. So when we talk about leverage trading, we need to have two things in mind. Okay, so the first thing we need to have is a strategy, okay? And the second thing we need to have is a trade plan for this strategy. So in trading, I'm sure you have your own strategy, right? So before that, you need to know firstly which product you're looking to trade. Example, you're looking to trade the S&P index, you're looking to trade the euro-dollar FX pair, you're looking to trade dollar-yen, you're looking to trade gold. So you need to know which market you are actually diving into. The second criteria, of course, is your conditions to enter the trade. Okay, so these are your rules, your conditions. You could be doing like a trend following trade, a mean reversion. Regardless of what it is, you need to have these rules in place. Third will be your trading style, depending on your time frame as well. So it could be a scalper, swing trading, position trading, example. So there's a lot of things you can do in trading depending on your personality, depending on the time you have available to trade, and what works best for you. And lastly, of course, is the time frame. So you can be looking at the daily chart, the hourly chart, 15-minute chart example. And once you have this view, right, or the idea of how you want to trade, the next thing you need to go into is the execution side of things, right? So after you determine all your conditions, what time frame, you just want to do an intraday trade, you want to get in today, get out today, you need to come up with a trade plan. So trade plan, we keep it simple. Just remember these four letters, DEEP. Okay, so DEP stands for direction, entry, exit, and position size. And these four is the bare minimum that we need to consider when we enter the trade. So direction is straightforward, right? So if you think that prices will go up, then you are buying the underlying market, or you are going on a long position. If you think prices will go down, then you are shorting the market or entering a short position, or you can enter a sell position. Entry definitely is where is your entry. So you can have conditions for entries as well. So I'll share a little bit later on a trend trading setup on the rules for this entry. And of course, exits as well. So exits, right? Let's not take it from just like a stop loss perspective, right? When we talk about exits, because exits can also be potentially in profits. So you can have like, you need to consider things like your risk reward ratio. What is the amount of risk you're taking for this trade? And another thing you need to take note for exits is on slippages, right? So sometimes you may have a level that you think that, no, if prices touches this level, I want to cut my losses. But then sometimes there's slippages, there's market gaps, and you tend to see that your trades are executed at a worse off pricing than what you intended. So just be very careful of that. I will share a little more on how knockouts can help you to counter that. And the last thing you need to be aware of is, of course, the position size. Okay, so after you have an entry level, you have an exit level, what you need to be very aware of is how are you sizing this trade based on your account equity. So example, if you have a $10,000 account, how much should you risk on this trade? You have a 50,000 account, how much are you risking on this trade? Is it too big? Is it too small? Is it, are you taking the appropriate risk management measures to enter the trade? Okay, so I'll share a little bit more later as well. Pardon me if I'm coughing a little today, not feeling the best. Okay, so one thing I also wanted to highlight would be that in trading, right, you need to brace yourself for the black swan events or the unexpected events. The market is dynamic, and there will always be occasions, right, where prices go haywire, and it can go haywire in a very short time frame. So these are actually abnormalities that don't usually happen, and you may have experienced or seen them, or you may have not. Okay, so in this case of 2020, right, there was when the impact of COVID, right, it drove oil prices to negative territory for the first time in history as the demand for oil fell, right. So this was because there were a lot of lockdowns, restricted travel, example. And due to the oversupply of oil, right, the oil producers had to face this storage issue. So what happened back then was that we see, when the oil prices went to negative territory, it's a situation that nobody will actually imagine that this could even be possible. Because people just imagine that the oil sellers are paying money to buyers to get it off them. So that's quite a very weird scenario to happen. So just be a bit more careful when you're doing your trade, because the market can always turn for the unexpected. Okay, can make a turn for that. So when we hear about this knockouts product, right, I'm not sure if you have heard of it before, but if you have not, let me just introduce this product again before I go into the trading strategy portion. So knockouts, you can think of it as like a boxing, right? So in boxing, when you hear like a boxer gets knocked out, right, immediately the referee will stop the entire boxing match, right? So conceptually, it's the same. So this product knockout, right, it focuses a lot on risk management, whereby if your trade is being knocked out, right, it acts as a stop loss level and it exits the trade for you. Okay, so let's dive a little bit deeper into this product. Okay, so knockouts are actually not as complicated as you may think it will be. So the first thing about knockout is that you can express both views. So by expressing both views, meaning to say if you are bullish on the market, you can buy a bull knockout. If you are bearish on the market, you can buy a bear knockout. Okay, so take note that you cannot short a knockout, you can only buy a knockout. So you either buy a bullish knockout CFD or you buy a bearish knockout CFD, depending on your view, whether you're thinking that the underlying market prices will it be going higher or is it going lower. Okay, so that's just like a normal trade, right? I go long if I think the prices will go up, and I short it if I think prices will dip. So in the case of knockout, you don't short, you go long on both sides, but you go long on the bull contract if you think prices will go up, and you go long on a bear contract if you think that the prices will go down. Okay, so another thing about this product that is that you need to indicate something called a knockout level. And if you look at this chart here, right, this picture here in the center of the slide, right, you notice that, let's say if the underlying market price is this middle line, And if I'm going bull, means I think that the prices will go up. So if I'm buying at this line to think that prices will go up, then my knockout level has to be below, right? Because if I've been buying this price to go up, if the price didn't go according to my view and it went down, then it means that this direction of it going down is a loss to me. So the knockout level has to be below my entry. But on the other hand, right, if you are going for a short position, meaning to say you buy a bear knockout CFD, so this time what you are betting on is that the markets will actually have a dip in the prices. And if the prices happen to go above your entry price, that is when you experience some losses, okay? So when that happens, the knockout level has to be above your entry price in a bear knockout CFD. And knockout CFD are actually a limited risk product. It means that you can actually know your maximum loss in advance. So before you even enter this knockout trade, right, you will be able to know that, okay, for this trade, the maximum risk I'm taking, let's say, is $200. So no matter what happens to the market, even if there's a dislocation, there's an alien invasion next day, IG will honor regardless of what the market price is. If there is a big gap in the prices, we will still honor our word and get you out at the knockout level. Okay, so this is one of the safety mechanisms. And knockouts move one for one with the underlying IG price. So what this means is that in our trading platform, right, you may happen to see the same product in two different instruments. So what I mean is that maybe you are looking at the S&P 500 CFD index. Okay, so just a normal CFD index. And then you look at another ticker, there is this S&P 500 knockout. So if you compare the prices, right, prices meaning to say the bid and offer for the underlying CFD and the bid and offer for the knockout trade, right, both move one for one. They are exactly the same. Okay, so the pricing wise, there's no discrepancy. It's according to the underlying market. And for knockouts, there is this expiry every year on the August. So for 2023, it expires on the August, but you don't have to wait for it to expire as well. Anytime you want to exit the trade, you can exit. So what happens if it expires? It means that your trade will be closed. And then if you want to enter the trade again, you need to reopen the trade. Okay, so even if there is an expiry date, right, please don't misconstrue this as an options. You will not be able to sell a knockout product to receive premium, unlike options. Okay, so just be very careful and be a bit more clear on that. So this is just an example of a bull knockout CFD. So if your view is that the underlying market, right? So in this example, let's just assume that this 26,000 is a Hang Seng index, just an assumption. So let's say we know that this Hang Seng index currently right now is 26,050 points. And if your direction is to go bull, right, to buy a bull knockout, then the knockout level has to be below 26,050 points. So you need to set the knockout level somewhere below. And what happens is that if the market happens to reach that level, then your trade will be closed. Okay, so just take note that this is not too complicated. It's just an entry price, a knockout level, which is a stop loss level. But you don't have to wait for the market to hit the knockout level to close the trade. At any point of time during your trade, even if you want to close it the next second, the next minute after entering, you can do so as well. Okay, it's not restricted to only closing it once it reaches the knockout level. All right, so this is how it looks like in the trading platform. And if we have time later, I will just demonstrate on a demo account. So I'm just trying to explain a little bit more on the trade ticket for the existing clients. If you have been trading with IG, then this on the desktop platform or web trading platform, then this shouldn't be something that's too stranger to you. It should be something more familiar. So in this trade ticket, right, you know that at the top left-hand corner of the chart, just let me on the pointer option. Okay, so at the top left-hand corner of the chart, you'll see that there's this US 500 bull KO. So that's the instrument. And on the right hand, this is what we call the trade ticket. So this is where you key the instructions to tell the platform at what levels you want to execute the trade, at what levels to close off your trades in losses, and what levels to close off the trade in profits. Okay, so in this example, you notice that this is a bull knockout. So meaning to say we think that the prices will go up from this level. And if the current market price at the time of this screenshot, if S&P 500 was at 3,800 and about 50 points, the knockout level would be lower because we are speculating that prices will go up. So our cut loss level has to be below our entry. So it's a bit lower. Exactly how many points lower is 3660 away from our entry of 3849. It's shown over here, distance away. Okay, so the knockout level is about 189 points away from our entry, and you notice that there's this knockout premium. Okay, so knockout premium is actually a fee that you will incur if your position is knocked out. Okay, so that is a fee, but just take note that if your positions is not knocked out, right, then this fee will be refunded to you. So think of it like an insurance, just that it's a better version of an insurance, because in insurance, right, when you buy it, right, you have to pay the premium regardless of whether you use it or not. But in this case, you pay the premium upfront first, and if you happen not to use it, right, it doesn't trigger, you get the premium back. Okay, so just be very clear, there's a difference between this and like guaranteed stop loss as well. So below the trade ticket, right, you see that there is a size. So this is the position size, the trade size you want to enter, and there are two more fields here, a stop and a limit. So stop is actually a normal stop loss, and it is a bit different from the knockout level. So normal stop loss is basically a free stop loss level for you to indicate. And if prices hit this stop loss level, right, you will close your trade in losses. But if it's triggered by the normal stop loss, then this knockout premium will be refunded. The only way that you will incur this knockout premium, right, is when the trade, right, is closed at the knockout level of 3660. But if you take a look at this chart here, right, if your entry is over here at this blue line, okay, limit over here is your take profit. So if you're buying over here, right, this purple area, right, is where that if prices happen to reach this purple line, you will close your trade in profits. And exactly how much in profits you can see over here. So it's about 233 points away, and the profit is about $233. And you can put a normal stop loss in between your entry and your knockout level. Okay, so in between your entry and knockout level, you can indicate a normal stop loss as well. And if prices trends lower and it touches your normal stop loss, your trade will be closed, but the knockout premium will be refunded. Okay, so what is the use of this knockout then if the trade is closed here? So the use of this knockout level is when there is huge market volatility or dislocation. So this knockout level guarantees you that this is the last line of the defense of your trade. So no matter what happens, even if next day the price open at let's say 3,500 and there's a huge gap over here, and this is more commonly in the equities market. So if you look at shares trading, right, many a times if you trade shares, you notice that today, right, prices are trading at a certain level, and then the exchange closes, right, and next day when the exchange open, you tend to see some of the candles, right, it gets either above or below depending on the market sentiment. So when that happens, right, then this knockout level will come in because there is no price to trigger your stop loss. Your trades will be closed exactly at this knockout level without any slippages. Okay, so imagine if next day the market gaps to 3,005 and there's a huge gap over here, right? We will get you up at 3,660, and the additional 160 points you save is your benefit. Okay, because the market traded way below, but you don't have to go through this slippage or market gap. Okay, so we will honor you and get you out at whatever knockout price, and that's the whole point of using knockout. So it gives you two levels of defense. The first one is your normal stop loss, just like any trading platform. There's just a normal stop loss. But like all platforms, the stop loss, the free stop loss is subjected to slippages and market gaps. But if you're using the guaranteed stop loss, right, then there's a premium as well. So by using knockouts, you get to enjoy two stop loss level, the normal stop loss and the knockout level. Okay. So moving on. Okay, so this is just another example of the bear knockout. So in the bear knockouts, you notice that the direction is bear and your entry price is 3843 again for the same S&P 500. You notice that the knockout level here, it has to be higher. You can click on this down arrow. There's a whole list of a whole list of knockout level for you to choose. So choose the appropriate knockout level. It has to be higher. And same thing again, your position size, your exits, meaning your normal stop loss and your take profit level. And the rest, it works exactly the same, just like a bull knockout. Okay, so this is just the reverse side. If you're thinking of shorting the market, then you click on the bear, which is a down arrow as well. If you think that the prices will go up, then click on the bull, which is this up arrow. Okay. Okay, so in IG, right, in the early days, right, when the team was designing this product, right, we already noticed that we already have guaranteed stop loss, in fact. But although guaranteed stop loss is being offered, right, we notice a lot of clients don't really use them. And I think it's because of the premium. when you are trading, right, you already have the cost of trading, you have the spreads, you have some of the commission here and there. And then if you think that, well, if I need to incur another fee for putting this guaranteed stop loss, it's a bit like a turn off, right? The trading cost becomes very high. So sometimes you notice that the first problem is that if you don't use guaranteed stop loss, then when the market gaps, right, you see that there's this hole here. If you're shorting at this level and the market gaps up and you have a stop loss just above the highs here, then you notice that the broker cannot liquidate you at the level you want. They have to liquidate you at a worse off pricing. That's because the market didn't even have that price, wasn't even trading at that price. So when that happens, you notice that, okay, you need to lose more money than you're willing. That's number one. Number two is that if you want to use a guaranteed stop loss to make sure that, if I put a stop loss here, I want to guarantee it close out at this level. Sometimes the guaranteed stop loss, right, the minimum distance away from your entry is too far. Okay, and if you're using the normal stop loss, you tend to see that the normal stop loss, right, you can put it closer to your entry, but the guaranteed stop is too far. So you don't want to take this stop loss, it's way too far of your target. You want something closer, and that's why we came up with this product, which is the knockouts. So the solution here is that you have an entry price. We let you have both of these in one trade ticket, a normal stop loss and a guaranteed stop loss. But the guaranteed stop loss, we rename it to a knockout level. That's all. Okay, everything else remains the same. You still can have your entry, you can put in your take profit level, but this time we give it, we provide you with more solutions to give you two options to have a guaranteed stop loss and another normal stop loss. Okay, so the trick is that after you have a guaranteed stop loss, right, put the normal stop loss somewhere in between. So if that the market trades normally without any huge volatility or market gaps, at least your trade get closed out in the free manner. You don't need to incur any additional premium. It's just like a normal trade. But in the case that there is a huge news, a high impact economic news that causes the market to have some huge gaps, right? Then at least you know that you have this knockout level in place to make sure that you don't tank any further losses past this level. Okay, so that's a little bit of sharing on this product. So once again, double stop loss as well. So just take note that the knockout level is not amendable. Once you set this level and once you click on this place deal button, right, this level is fixed. You cannot go back to your position and amend the knockout level. It's a fixed level. But what you can amend is this stop level. You can amend the stop loss line, but you cannot amend the knockout line. Okay, so the only way to amend this line is to close the position and enter a new position. But just be very sure when you are trading, have this trade plan in mind already so that you don't need to go to such measures. Okay, and if you really need to amend the stop loss, it is still a function for you. Okay. Okay, so knockout level is fixed at 3007. This line here, the orange line, is movable. Okay, so you can always amend this if you want it. Okay, so since the stop loss is adjustable even you enter the trade, right? So what you can do is that if the market is moving in your favor, right, you can actually move the stop loss up similarly to how a trailing stop works, right? So trailing stops are basically stop loss that if the market trends in your direction, the stop loss automatically shifts up accordingly as well. And this stop loss can become like a take profit mechanism as well. So exactly the same in knockouts, right? You notice that inside your positions tab, right, you can actually amend this stop level. So how we can read this is that when you're entering a knockout trade, right, it shows you how many points you're away from being knocked out. So example for this trade, right, is US 500, which is S&P 500. So let's say if I'm entering it at a knockout level of 3626. Okay, so that's about 85, 3625, that's about 85 points away from being knocked out. Okay, and the current market price is 88 points away from being knocked out. So this is my entry price. This is 85 points away from being knocked out. Right now, I'm 88 points away from being knocked out. It means that the market moved a bit higher. Okay, so this way I can actually move the stop loss up. Okay, and you can use this stop loss, right? So if your trade is in profit, you can move this stop loss line a bit up so that when prices go down, right, this adjustable stop loss can become a take profit mechanism as well. Okay, so just a small trick for you. And again, this knockout level is fixed at 3007. This is a non-amendable level, but this stop level is amendable. Okay, so just a quick recap on the product again. what we went through was two knockouts, and we only have these two. It's either a bull knockout or a bear knockout. So again, you need to establish whether you are bullish or bearish depending on your market views. If you are bullish, buy a bull knockout. If you are bearish, buy a bear knockout. Okay, and this product, it helps you to better manage your risk with two stop losses, a normal stop loss and a guaranteed stop loss that is not subjected to any slippages, and that is the knockout level. Normal stop loss, you are able to adjust or move it to break even or even close in profit, but the knockout level is fixed. And of course, what this means is that since you know the knockout level is fixed and this is your maximum loss, right? Your entry and the knockout level, what you are essentially doing is that you're locking in your maximum loss in advance. So you're very clear that this trade, if I'm risking $200, then nothing can happen to this $200. If the next day, the market gaps, I know that, okay, the maximum loss regardless is just $200. But even before we reach the knockout level, again, I just want to recap, you can close the trade at any point of time. Okay, I buy a bull knockout right now, I want to sell in the next minute. In profits, I can do so as well. Okay, so just like a normal trade. Okay, so before I move on to the next part on the strategy, just let me take a look at the questions. Okay, the first question is, can the knockout value be changed once we enter the position? Any overnight charges? Okay, so the knockout value cannot be changed once you enter the position. Overnight charges, yes, you will still incur overnight charges just like any CFD or any leverage product. Okay. Second question, any interest payable for overnight trade? Okay, so similarly like the first question as well. So yes, once again, regardless if you are trading leverage product, then yes, there will be overnight holding fees as well. But to be honest, the fees isn't very high. And if you are doing leverage trade, I always suggest that you do not hold the trades for an extended period of time. And by extended, I mean like a few years or even like close to a year kind. If you are doing a swing trade, it could be days to weeks or even 1 to 2 months. You won't really incur a very significant amount unless you're holding it, for a very long period of time. Okay, if I have time, I will share on the page later as well to give you an idea of what the cost is like. Okay, so you have a rough idea on the amount. Okay, so moving on, let's look at the plan. Excuse me. Okay, so just a quick recap of what we went through previously on the strategy and the trade plan. So today I just wanted to share a very simple trading setup and a trading plan by following this DEEP execution formula, and then how we can use this knockout trade ticket to execute our views. Of course, you can have your own trading strategy and your own trade plan. Please do not just follow this blindly, and be wary that there's no trading strategy that works all the time as well. But at least what I'm trying to do here is to give you some context, some idea and basis, like a framework for you to execute trades. Okay, so just take a look at, let's just now move on to take a look at a very simple setup for this trend trading. Okay, so the first thing when we talk about trend trading, right, we want to ask ourselves this question, is there a prevailing trend? Okay, so in terms of market structure, right, the market is either in an uptrend, a downtrend, or ranging on consolidating. Okay, so you need to know to identify uptrends. It is of course higher highs and higher lows. Downtrend is lower highs and lower lows. Very straightforward. Ranging is just that you notice there's this horizontal, or it can be a channel as well. And then prices are just trading within this channel, this range. Okay, so markets are just ranging. So if you look at the chart over here, okay, so obviously this is an uptrend, is for the Nasdaq. Okay, so you notice that back in COVID, right, so this daily chart, and I took this screenshot I think sometime towards the end of last year. So you notice that this prices went down, right? It was bearish during March, during the COVID period. And then the US market for US tech, this is the Nasdaq index, by the way, US tech 100, it recovered and formed quite a strong uptrend, right? So you notice that this swing high, it broke above it, higher highs, and then over here you start to see that it consolidated a bit, right? There was this swing high, prices didn't break this high to form a higher high. It formed kind of like a range here. Okay, so if you draw the horizontal resistance, right, over here, and you draw this trend line here, right, it's kind of like an ascending triangle, and then it broke out and went into an uptrend again. So what we do here is that when we look at this, right, notice that downtrend over here, uptrend over here, ranging over here, and uptrend again. So what we want to do here is that when it's in an uptrend, right, we want to look out for long positions. So our biasness when we determine that, we know that the market is in an uptrend, we want to enter into buy trades. And when the market is in a downtrend, on the other hand, what we want to do is to enter a sell trade. So downtrend again, you notice again lower highs, lower lows, right? So nothing too complicated. It is just that sometimes the market, it doesn't form so nicely. Okay, so again, same theory. We don't want to swim opposite the direction. We want to go with the path of the least resistance. So if prices are trending up, we try to ride the trend, try to look for long entries. If there isn't any long entries or no trading opportunities or setups, then stay out of it. It's okay. If it's in a downtrend, we don't try to time the bottom to buy it. We try to sell at retracements as well. Okay, so we try to sell in a downtrend. We don't try to buy in a downtrend. Okay, so that's the logic we are going here. And of course, in the markets can also be ranging, right? So in ranging, we believe that prices are kept within this certain support and resistance, and the belief is that this support and resistance will hold. Okay, so ranging, it is not too difficult. If your belief is that this will hold, right, then the setup is very easy, right? Because the levels are very clear to you already. If it touches this resistance, let's say it's touching the third time, if you put a sell position here, then your stop loss is very easy, right? It's just above the previous swing high or above this resistance level. You can try to ride a short position all the way down to the previous support level again. Okay, so this part of what we just went through is the D portion of the DEEP to find the direction of our trade, whether we are going to buy or whether we are going to sell. Okay, so the next part, which is a bit harder, would be on the entry itself, right? So we know that the direction is to buy, but when do we enter this buy trade, right? So the first thing we want to know, firstly, is to do a confirmation using moving averages. Okay, so moving averages is very useful, okay, and it's very popularly used by all traders. So if you're new to trading, please try to explore a bit more into moving averages. So moving averages are actually the average price of an underlying asset over a specific period of time. Exactly what is the period of time is up to you to set. So a very popular number that traders use is the 200 moving average. So if you're looking at the daily chart, then the 200-day moving average is actually a very smooth line. And if prices are trading above that line, then we will have a bullish bias, or we try to find long positions. And if prices are trading below that, then we try to find for short positions. Okay, so other than using moving averages to identify trends, right? The next thing that moving averages can do is also they are actually support and resistance lines. So these lines are similar to how you would see like a horizontal support or resistance, but this using the average price over a period of time, we can also use these lines as support and resistance. So popularly, you notice that for moving averages, people usually either use the simple moving average or the SMA or the EMA. So SMA is just dividing the closing price over a specific period of time. So let's say if it closes $10 today, $20 tomorrow, $10 the day before yesterday, $20 yesterday, and $30 today. Then you add this three up to $60, you divide it by 3 days, you get $20. So that's the average. Okay, so that's just the average price. Exponential moving average, right? It weighs a little bit more emphasis on the recent price. So you notice that if the price is 10, 20, and 30, the average is not 20. The average is probably somewhere between 20 and 30, because the calculation is that is by the way, it's calculated by the platform. You don't have to do it. It places a little bit more emphasis on the recent price, so that it reacts to price a little better. That's the reason why people like exponential moving average. And if you ask me which one to really use, personally, I think it depends on you. But I think if you are trading a little bit more short term, I feel that the exponential moving average, it reacts to prices a little better. It's a little bit more up to date than the SMA, although it can look a little bit more erratic looking. So the prices are more, it's less smooth compared to the moving average, simple moving average. Okay, so that's one. So of course over here, right, if we add this indicator in, right, to the trading platform, you notice that these lines are appearing. So over these lines, you can see that this is the period I'm using: 20, 50, 100, and 200 exponential moving average. Okay, so one thing to take note of is how these lines are lining up. If the shorter line, right, the faster moving average is lining up very nicely above the slower lines, then the trend is very strong, right? It's very prevalent, right? Such that the longer moving average is a smoother line. The shorter moving average is is still a quite a smooth line, but it lines up very nicely on top of one another. Okay, so in this trading setup, right, we are using the 200-day moving average, which is this orange line, to determine the direction bias. Okay, so when it's trending in a certain direction, right, then moving averages stacks up nicely. You notice that they are also prices are also bouncing off these moving averages because again they act as a support in an uptrend. Okay, so when prices retrace, right, sometimes you notice that the faster moving averages, right, will crisscross each other as well. Okay, but that's fine. That's very common when prices retrace. But just take note that if the prices is still trading, prices mean you say the last candle, right, if it's still trading above the 200 moving average, right, then we will try to have a bullish bias. Okay. So next one, again, in a downtrend, you notice that the shorter term moving averages stacks up nicely below the longer term moving averages. So over here, you notice the left side of this chart, right? This is a gold chart. Notice that previously it was uptrend, right? So the short term moving averages were lining up nicely above the long term. And then it crosses over, cuts through the shorter term, cuts through the longer term moving averages, and now it forms a downtrend. Okay, so once again, you notice that prices may bounce off moving averages because if they are trading below, right, then these lines also acts as a resistance. So here are just two examples of this moving averages line. Excuse me. Okay, but sometimes we look at the markets. Okay, so let's say we look at this particular market over here. Are we able to exactly tell if this is an uptrend or downtrend if we just look at the candlesticks here? Okay, it's a little bit hard, right? Anyone want to make a guess whether you can type it in the question box whether it's a downtrend or uptrend or ranging, Okay, I see some ranging, consolidation. Yep, yep. Three also have, yes. Okay, so what we do is that if we really want to tell the trend, right, what we can do is that we add in the moving average line, because sometimes the human eye, right, when we just look at it from one view and we didn't scroll to look at historical prices or zoom out at the chart, right, it's a bit hard to tell. So what we do is that we add in the moving average line. Okay, so in the moving average line, you can see that okay, actually prior to this, right, it was an uptrend. Okay, but if you look at the more recent price action, the uptrend didn't have higher highs. It went to kind of like consolidation, right? And then after that it became a bit more bearish. It even broke the 200-day moving average. Okay, so it gives you a clearer picture once you add in these lines, and then you see where are the current prices. How far away are they from the lines? So just take note that this is a weekly chart for gold. So this is a very high time frame. It's a weekly chart. Sometime back in October, I took last year as well. But let's not be too concerned about the date and just look a bit more, focus a little bit more into the price action and the theory over here. So over here, we notice that the prices, right, they have already broken the 200-day exponential moving average. And it's kind of forming like a resistance, right? So if broken, it tests a bit and it didn't manage to close above the 200-day moving exponential moving average. So this could be a potential sign that it is reversing already. Okay, and for this particular trend trading strategy, just remember our rule is to determine the trade direction as long as the prices are above. So if prices are above this 200-day exponential moving average, right, 200 period exponential moving average, then we will try to find long entries. But if they're trading below, then what we want to do is to follow the trend and look for short entries. And in this example, this is a weekly chart from a higher time frame. So share prices are trading below. So what we are trying to do is we will have this bearish bias and try to find sell positions at kind of like at an area of value. Okay, so next we zoom in into a shorter time frame. Then we zoom in into the daily chart. Okay, so the chart previously was weekly, and then if we zoom in into the daily chart, right, we can also use the exponential moving average, apply it to the daily chart. Okay, and then you see how prices are doing in the daily chart. So one way to sell this or to enter a trade, right, a potential entry would not be to immediately sell when the prices break below. Okay, so once it breaks below, right, just try to look for retracements during the trend. Okay, so of course we know that when markets are trending, right, if it's in an uptrend, it doesn't go one straight line like a rocket to the moon, right? It goes up, it retraces, it goes up, it retraces. So there's always all this dip or buying and selling opportunities in an uptrend. There will always be some retraces here and there. It doesn't go up one straight line. So what we are trying to do is that now we have established a bias. We are looking for sell positions. But where do we exactly sell? At which point in this downtrend do we sell? So the first point that we want to look out for is for retracement. Okay, so by applying this very simple moving average, right, this exponential moving average into the chart, wait for prices to test these moving averages, okay? And if it is being resisted by, let's say this is a 100-day moving average. If it's being resisted, and then you notice, oh, there's even a bearish candlestick pattern, right? This bearish engulfing. So when that happens, right, then it could be a potential entry. So this is how you can potentially time your entry in a trend trading setup. Have the bias at a longer time frame. Okay, so longer time frame, we know that okay, prices are trading below the 200-day moving average. Potentially, this could be the start of a downtrend. Then we zoom in into a smaller time frame, right? Instead of a higher time frame, we go into a smaller time frame. It can be an hourly chart, it can be a 4-hour chart, it can be a daily chart, depending on your time frame. Wait for prices to retrace and wait for it to test the retracement level, certain levels. Wait for another additional confirmation. So the first confirmation that I'm using here is actually the candlestick pattern. Okay, so that's one. Okay, so potentially wait for prices to retrace, wait for an additional confirmation, then this could be a potential short setup. Okay, so that's one way. The second way, again, if we are not using the moving averages, right, you can also use what we call like this tool, the Fibonacci retracement tool. So this is one tool that we can use it to time our entries as well. So how you use this tool is that if the markets are going in a downtrend or in an uptrend, right, you can draw the lines from a previous swing high to the swing low. So how you draw it is always from the left to the right. Okay, so you don't click the starting point over here and then drag it over here. You click on the high here on the left side, right? It's always left to right. So in an uptrend, you click from the left to the right. Your direction should be, bottom left to top right. In a downtrend, you click from the top left to bottom right. So once you draw this Fibonacci retracement, right, it will show you the different Fibonacci levels. So some very key levels that is a lot of people are looking at on the more popular levels are 50%, 61.8, and 38.2. Okay, so what it means is that from this range, right, of 1878 all the way down to 1681, this is the midpoint. So within here, this is probably about $200. So 50% is about $100 away from this. So it's the midpoint between this whole swing. So what it means is that if it retraces to this level, this is a 50% retracement. Okay, so if the prices from the swing high, it goes to this swing low and it retraces here. So this is about 61.8% of the retracement. Okay, so you notice that this level at this 61.8%, there is some form of resistance as well over here. So in this example, right, by using the Fibonacci retracement, when we are looking for short entries, right, or even long entries, it's just the opposite, right? So long entries, instead of looking at price, entering a sell position, right, we are looking at buy positions in an uptrend, but we are looking for the prices to retrace to certain support levels, and then we try to find a long position at that support level, like kind of like an area of value. Okay, so in this example of the goal, right, so in a higher time frame, trading below 200, bearish buyers looking for sell entries. Where to exactly sell? We can try to use the Fibonacci retracement. Once again, draw from a swing high to swing low, look at how prices react to these levels. And since there is this bullish engulfing at this 61.8, this is quite a strong resistance, kind of like a confluence, a bearish engulfing, and resisted at this Fibonacci level, potentially you can take a shot. Okay, so this is one way you can time your shot. Another way, of course, is you add in both, right? So we talk about the exponential moving average. We talk about the Fibo retracement. The stronger way is if you add both of them together in your charts. And if you have more and more confirmations, right? So you have the 100-day moving average as a resistance. You have the Fibonacci retracement exactly at the 61.8. That's another level that's resisting the gold prices. Then don't you think that this trading setup, although nothing is guaranteed, it has a higher probability that prices will actually be trending down. Since the higher time frame, the price action is a little bit more bearish. In the lower time frame, is being resisted at two levels, right? The 100-day moving average and the 61.8 Fibo retracement level, and there is this bearish engulfing candle. So there's a lot of levels, although not guaranteed. Once again, like I said, nothing is guaranteed. Prices can still potentially break out. But what we are trying to do in trading is to enter potential trades that have higher probabilities. Okay, so if you ask me, I would think that this is probably one of the better trades you can take, because you can actually you can actually try to have a setup, right, where you can put in your stop loss level just at the somewhere above the previous swing high, and you can write this downtrend all the way below here. Or if not, if you're a bit more conservative, you can put it above the 200 EMA, so not so far to this level. Put it just slightly above the 200 EMA, but your take profit could be somewhere around this level, or even to this swing low. So your risk to reward in this setup is better. Your stop loss level is very tight, but your take profit potentially could be a very big swing. Okay, of course, there's a lot of ways to determine your stop loss. You can also use another tool called the ATR, or the average true range. So it just measures the length of the bars previously, the volatility of the market, and it tells you an average of, what is the average point movement, dollar movement of the underlying market, and then you can use it as a gauge to put that point movement on top of your entry, such that you don't get wiped out due to the short-term volatilities. But once again, there's a lot of ways you can do. You can look at moving averages, you can look at Fibo levels, you can look at the previous swing high, you can use ATR for your stop loss. Okay, but what I wanted to really emphasize is on the setup. Okay, so the setup is that your risk to reward, it has to make sense, right? So everything has to make sense, so that you know that when you enter this trade, you have the conviction to hold it, right? So you know that if it breaks above this level, then probably is where I cut loss. My view may be wrong. I'm happy to take the loss. I move on to the next trade. But if I'm right, then potentially this is my profit. I'm risking, maybe it's a kind of like a 1:3, risking 1:3 risk to reward ratio. So this is potentially something that you need to think about even before you enter the trade. Okay. So the second indicator that we want to use this time is using a momentum indicator. So our entries will be another confirmation we can use is this momentum indicator called the relative strength index. So we use this as a secondary confirmation. To put it simply, right, if you notice that this relative strength index, right, by default we show two levels, 70 and 30. If it's showing a level that's above 70, right, so what it means is that this is actually overbought. It means that basically how we count this is that we use the average gain and the average loss in this calculation. Overbought means that the average gain is more than the average loss in a given time period, and it means that there's a lot of buying momentum. Okay, so what it means is that if there's a lot of buying momentum, what you're trying to do is that it can be potentially trying to tell you that it has been overbought. There's too much buying in this short time frame. You may want to look for a sell position. And of course, there can also be oversold situation, meaning to say that the prices dip down too quickly already and is being oversold in an oversold condition. And what it's trying to tell you is that you may be there may be buying opportunities once it's oversold. Again, this is not the only way you can use it. Some people use it as crossover, to enter buy positions when this line crosses 30. Some people don't even look at 70 and 30. They just look at one midline 50. And just look at whether it's trading above 50, below 50, if it's bullish above 50, bearish below 50, or whether prices cross above 50 to enter a long entry, cross below 50, enter a short entry. Entirely many ways for you to use it. But for us today, to keep things simple, if it's overbought, we try to sell an overbought market. If it's oversold, we try to buy an oversold market. Okay, so we use this as a secondary confirmation. Okay, so again, if we apply it to the charts, right? So in this example, we're looking at the Russell 200. Okay, so firstly, we add in the exponential moving averages, right? So we see all these lines coming up. So previously it was bearish. So we noticed that the short-term moving averages, prices were trading below, being resisted by all these lines, and then it broke above, and then it became uptrend. So again, what we are trying to do in the uptrend is we are trying to buy. So where do we buy? We buy at area of value whereby prices retest the moving averages, retest certain Fibonacci retracement levels, using candlestick patterns as a confirmation. But this time we are also using RSI as a confirmation if you want. So we notice that, it tests the 200-day moving average, it tests the 100-day moving average, but are these levels good levels to buy? So potentially we can add in this RSI indicator at the bottom of the trading platform and look for, in a buying setup, we are trying to look for oversold conditions. Okay, so we are trying to look for when the RSI is at the level of 30. So if the trend is still uptrend and we know that this retracement is too fast down and it touches and is testing certain support levels, and the RSI is showing that this is being oversold, right? In the near term, there's too much selling in this short time frame. We can look to buy as a confirmation and is being supported by the moving average line. So you can use this as an additional confirmation as well, where you see that prices are testing certain support levels, and then we use this RSI as another tool. So we are trying to just find confluences between our trading setups. Of course, if we always have too many conditions, right? Like if our first rule is that prices needs to be supported at certain lines, like it cannot break the 100-day moving average. And then the second one, okay, it has to be being supported by a certain Fibonacci retracement level, let's say the 61.8%. And then right now, if you add another condition that, when it reaches these levels, I add another rule that the RSI must be oversold, then I enter into this buy trade. Then notice that as the conditions pile in, right, then you tend to have lesser entries, right, because of so many rules. So you want to play around to see what works best for you and what has the best the highest probability setup for you. Of course, once all these rules, if the more rules you have and all these rules, at one point there's confluence, right, then the probability of this trade being in profit is way higher, right, than if you're using, let's say, just a very simple retracement and then a candlestick pattern. Right. So if you have a retracement to a moving average, at the same time it is being supported by a Fibonacci level and is being oversold, then you notice that actually there's more confluences in all these indicators, and then that is a high probability trade that we may want to take. Okay. So just to recap the setup, again, DEEP, first one is direction, identify uptrend or downtrend. How do we do that? Add in the exponential moving averages. Take a look at the higher time frame. Take a look if prices are trading above if prices are currently trading above the higher time frame. We can zoom it into a smaller time frame to look at the short-term price action. If it's bullish, we try not to short in the short term as well. We try to go along with the trend. We try to look for buy positions. If the long-term trend is has more bearishness in the price action, we try to look for short entries in our shorter time frame. Second is the entry, right? So if we know that it's an uptrend, we don't want to just enter immediately. We want to wait for retracement. Okay, so we add in the moving averages line, excuse me, and then wait for it to retrace us. Use candlestick patterns as confirmation. Use Fibonacci as well to see if it's testing both the moving average and Fibonacci levels. Using RSI as a confirmation as well. Exits, okay? So this could be, exit could be above the 200-day moving average. You can use ATR as well, which is the average true range. Position sizing, we try to keep it below 2% of our account size. Okay, so I'll just explain a little bit more here in this example. So over here, you notice that this is the downtrend, right? So prices are trading below. It went to test this 200-day moving average. Seems to be trying to form a new bull market. Again, this is US Tech 100, but it didn't manage to close above this level. Didn't hold. Prices tried to break above but got pushed back down. Okay, if we look at the Fibonacci retracement, right, we draw it from the 1 month high here, okay, to the 1 month low, right, swing high to swing low. You can see that the 50% mark, okay, this 50% mark was quite a strong resistance, right? And once the prices close below the 200-day moving average, right, this could potentially be an entry to sell again. So just an example only. So if you're looking to sell this using the knockouts, right, the knockouts deal ticket, the first thing you want to do is to click on the bear button over here. So again, this is your direction. Okay, so your direction, if you are bearish, click on the bear button. The next one is your entry. So your entry is this price level over here, the current market price. Okay, so that's the entry. And your exits. So again, exits, we talk about 2 stop loss and 1 take profit. So in the trade ticket, you will see 3 exits. So again, knockout level is the guaranteed stop loss whereby you are guaranteed to not close anywhere worse off than this pricing. Stop loss is a normal stop loss in between your entry and your knockout level. In between, you can put in a normal stop loss as well. And of course, your take profit will be a level that is higher. So if you look at this platform over here at the chart, right, you notice that this blue line is your entry. This yellowish line or orange line is your knockout level. And in between your entry and the knockout level, you can indicate a normal stop loss level. So this is free of charge. If this level gets reached first, right, means there's no market gap, there's no huge volatility, then if your knockout level is not triggered, the premium that you see over here will be refunded as well. Okay, so you don't have to pay for this. This is just an additional insurance that you don't need to pay unless it's triggered. The purple line here is the limit. So this is your take profit. So over here is the position sizing, is the last one that I didn't really touch on. So how you really size this, right, is based on this portion, your account equity. So let's say if I have a 55,000 trading account, I use a 1% rule. So meaning this trade, I don't want to risk more than 1% of 55K. So I'm only risking about $550. So what you can do is that you can click on this up or down button. And once you click on this, just be aware of this stop level here. Okay, so this 550, right, if you click up, right, this number will increase because you're entering a bigger trade. If you click down, this number will decrease as your trade size decreases. So you scale in, this is the last thing. You need to be aware of your entry and exits first. Once you have all this inside the trade ticket, then you scale in the last part, which is the P, the position size, okay? So just make sure that you're not risking too much on one trade, and what you want to have is longevity. Okay, running a bit short of time, so I'll just move through the examples a little faster. So another example over here, price above the 200-day moving average, moving average lining very nicely. The shorter term above the longer term, showing a very nice uptrend. You notice prices retrace, right? And currently still testing the 100-day EMA. RSI was also oversold at this level. So this was potentially a level that we could have gotten into. And again, apply the dip formula, right? Direction. So we look at the recent price, right? Is this a level that we can enter? Potentially yes as well. So if you miss this level, right, uptrend, it retraces to test and in a oversold condition. If you miss this, wait for it to retest again in an oversold, then potentially this could be a buy entry, a long setup. Okay, so again, one quick tip is that what we noticed was that a lot of this knockout product is actually a very popular product in our IG Japan office. So what we noticed was that the clients are actually very smart. So when they enter a knockout trade, what they did was that they put the normal stop loss 1 point away from being knocked out. Okay, so imagine if you are, let's say right now, 18 points away from being knocked out. If your normal stop loss is 1 point away from being knocked out, it means that your stop loss and your knockout level is essentially very close together. Okay, and if it triggers your stop loss first, then you can save on the knockout premium. Okay, so this is something that something for you to think about if you are trading knockouts with us. And this is actually how it looks like in the chart. So previously you saw that the knockout level and the stop loss was 2 separate lines, but you can actually put both of them very close together such that when prices hit first, right, it should hit the normal stop loss first so that your positions won't be knocked out. By doing so, right, you will be able to save on the premium. But the knockout level is there in case if the market gaps, meaning to say that you will not be close off at the worst off pricing if the market gaps. Okay, so there's kind of like a 2 levels for you, 2 safety nets. Okay, so just to wrap up, I just want to highlight that knockouts are one way for you to execute your trading plans with better risk management. Typically, if you're trading with other brokers, I don't think they let you put 2 stop losses in one trade ticket. So this is one way for you to explore, if you are trying to practice good risk management, if you think that you want to sleep better at night, you are trading shares and then you want to make sure that there is this guaranteed stop loss that can essentially protect your positions no matter what happens to the market, then knockouts are a product for you to explore into. And of course, if you have the ability to know the maximum losses on set, right? So if you're able to plan beforehand, no surprises, then even if the market dislocates, there won't be like a shock to you. And of course, again, 2 stop losses. And lastly, I just want to highlight that risk management has to always remain the number 1 priority if you are trading. So don't try to focus too much on the potential profits. Try to think more about how much I'm risking for this trade. And when we talk about the stop loss level, right? I think we want to tweak the mindset a little. We try not to amend the stop loss level once we enter the trade. So before we enter the trade, we want to be very clear. Okay, this line, this stop loss line is not to make us lose money. This stop loss line is, again, I repeat, is not for us to lose money. It is a level that invalidates our previous setup. So this level, you need to be very clear that if the prices break above your stop loss, then it means that your initial entry is invalidated. You are already, the markets prove your idea wrong. Okay, so whatever indicators, whatever confluences that you may have previously, once it touches your stop loss, you need to know that this level invalidates everything that we believe was right. Okay, so in trading, what we can do is that we can only, number 1, try to find high probability trades. Never 100%. Even if you can manage to always consistently do it at 55 or 60%, I think that's already very good. Second thing, you need to look at your risk reward, right? So if you're winning 60% of the time, but 40% of the loss, or if you're winning 90% of the time, but the 10% loss can wipe out all your profits, then there's no point, right? I'd rather you have a 50% win rate, but every time you lose $1. Every time you win $2. Okay, so what we want to do is we want to try to find high probability trading setups with good risk reward ratio. Okay, so that's the main aim. If we are unable to find that, then I think the better way to do it is just to sit up and just wait for opportunities. Okay, so again, I want to highlight to focus more on the risk management aspect, and Knockouts is one product to help you. And once you focus more on risk management, then the profits should be more attainable. Okay, then you just do it like a cowboy gung ho style, just trade without stop losses. If it's experiencing some losses, I enter an even bigger trade like a martingale strategy. Okay, so we don't want to do that in leverage trading. Try to have a trade plan before that. Execute your plan, look for high probability trading setups, try to have good risk reward, and practice good risk management. Okay, so let me see if we have any other questions, because if not, then we have come to the end. It's about 8:02 right now. Just wanted to highlight on the resources as well. So if you like content like this, we have a webinar library. We invite external traders to share with us their strategies, their views. We have our in-house market analysts as well sharing their views. A lot of content here. So what you need to do is that if you are new to trading, right, just Google IG Webinar Library Singapore, and you should be able to locate our webinar library. All right. If not, I want to thank everyone today for attending. I think most of you stayed throughout the session from start to the end. I appreciate your time with me this evening. If you can do me one last favor, is to just scan this QR code and provide feedback for this session. If you like the content today, I think a lot of comments previously that I received was, people want to learn more about trading setups and, what are the potential entry rules, conditions that people can look at. So this is something that I'm trying to, cater more to you. So if you have any kind of like a content that you have requests for on certain products, just let me know in this feedback form. And of course, we try our very best to cater to things that you would like to, content that you would like to consume. Okay. So just a last look at the question box. I don't see any questions. If not, I'll just leave this here for another minute. Okay, and I just want to highlight that if you are new to IG, we have a lot of resources to help you. We have this team called the New Business Team. So if you need help on the trading platform, you need help on any aspect, we always have this servicing team to guide you along. Be it you are trading with the Singapore office, you are trading with the UK office, with the Japan office, regardless wherever you are, we have a team to help you from the local office. Okay, so if not, once again, I want to thank everyone for joining me tonight. I'm going to end the webinar right now. Thanks again and have a great night. All right, see you guys in the next session, and goodbye.